Hello and welcome. We are discussing the topic of taxation and let us see what this previous year question is about. This question came in the year 2015. If you have seen, we have earlier also discussed a question regarding tax to GDP ratio. That time the question was that the tax to GDP ratio, it has steadily increased. In the last, this is a question of 2015. In 2016 also we have got a question regarding tax to GDP ratio. Alright, so in 2016 the question was that the tax to GDP ratio has steadily increased in the last 10 years. This was the question. And now in 2015 we see a question that a decrease in tax to GDP ratio indicates which of the following. That is, if a country's tax to GDP ratio is going down, what do we mean by that? First, slowing economic growth rate. Yes. As I discussed in 2016 question also, here also I will be telling you the same thing. That economy, it has a business cycle. That is growth, boom, recession, recovery. And then back to growth. So economy never goes up continuously, economy would never go down continuously, steadily. Economy would, GDP growth rate would go up, would go down, would go up, would go down. This is the graph of GDP growth rate and time. So obviously, if the GDP is at a higher level, that time the tax collection would also be higher, because the firms will be paying more taxes, the indirect tax collection will be more, income tax would be higher. At the same time, when the economy is going through downward phase, that time the government has to give tax breaks, the government has to give tax incentives, so that this stimulus package, this expansionary fiscal policy will be helping the economy to get back on track. So when would a decrease in GDP, tax to GDP ratio happen? Tax to GDP ratio, when would this happen? This would happen when the tax collection is less. And when would the tax collection less? When there is slowing economic growth rate. Alright, when the economic growth rate would be less, that time tax collection would, the government would have to reduce the taxes. So the first statement is correct, that a slowing economic growth rate would lead to a decrease in tax to GDP ratio. On the other hand, if the GDP growth rate is higher, the tax to GDP ratio would also be increasing. Alright. Second statement, less equitable distribution of national income. Thing is, these terms like tax to GDP ratio, even GDP, even just taxes, they are just aggregates. They would never tell us what is the distribution of income in a country. They would never tell whether there is poverty in the country or not. It would never tell whether there is inequality in the country or not. A tax to GDP ratio, taxes can just increase because of the corporate tax collection increasing. Tax collection would also increase if income tax collection in the country is increasing. There are multiple reasons why tax to GDP ratio may increase or decrease. But will it be telling anything about distribution of income in the country? It's very difficult. So whether it is less equitable, more equitable, we just cannot know it through tax to GDP ratio. So even if it was like an increase in tax to GDP ratio means more equitable distribution of national income, no, we cannot tell about it, because it doesn't even depend upon it. The equitable distribution of income, it doesn't depend upon tax to GDP ratio. Alright. So what's the answer of this question? Answer of this question is only A, that is tax to GDP ratio would mean, if tax to GDP ratio is reducing, it means the economic growth in the country is going down. Alright, so I hope you have understood this question. That's it for today. Thank you.